Green hydrogen is usually discussed as a technology story. New electrolyzers, falling costs, breakthrough efficiency curves. Most investors are introduced to it the same way they're introduced to early-stage tech: promising, volatile, and dependent on the future arriving on time. That framing alone has kept serious capital cautious. But at industrial ports, green hydrogen is not behaving like a technology bet at all. It behaves like infrastructure. The difference matters. Infrastructure attracts a different kind of capital. It is underwritten differently, it is evaluated differently, and it succeeds for different reasons. Ports are not places where new energy ideas go to be tested. They are places where energy systems are forced to work under pressure. Electricity, fuels, molecules, logistics, safety, and regulation already collide there every hour of every day. This density is precisely why green hydrogen begins to make sense at ports long before it makes sense anywhere else. The first reason investors should think differently about green hydrogen at ports is that ports already sit at the intersection of energy supply and energy demand. High-voltage grid connections terminate there. Pipeline corridors already exist. Utilities, control systems, and emergency infrastructure are already designed for hazardous, continuous industrial operation. When an electrolyzer is installed at a port, it is not inventing a new category of asset. It is plugging into an existing system that already knows how to manage risk, uptime, and scale. That alone changes the risk profile. Hydrogen projects fail fastest when they are forced to invent infrastructure from scratch. At ports, hydrogen inherits infrastructure instead. The second reason ports matter is power geography. Offshore wind and coastal renewables do not land in random places. They land where subsea cables, substations, and industrial demand already exist, which is almost always at or near ports. As renewable penetration increases, these landing points experience congestion, curtailment, and sometimes negative pricing. This is not a policy issue, it is grid physics. For investors, this is the moment where green hydrogen shifts from being expensive to being useful. Electricity that cannot move inland fast enough loses value. Green hydrogen absorbs that stranded electricity at the point of landing and converts it into a storable, usable industrial molecule. This is not about producing hydrogen everywhere cheaply. It is about producing hydrogen cheaply in very specific places where electrons are constrained. That location-specific advantage is why port hydrogen economics are not replicable inland. The technology may be the same, but the system context is not. The third reason green hydrogen at ports behaves like infrastructure is demand certainty. Ports already consume hydrogen at scale. Refineries use it continuously for hydrotreating and desulfurization. Chemical and fertilizer plants use it as a core feedstock. In most cases, this hydrogen is gray, produced from natural gas or delivered through established industrial gas systems. Green hydrogen does not need to create a new market at ports. It replaces an existing one. For investors, replacement markets behave very differently from speculative markets. Demand already exists. Consumption is continuous, downtime is unacceptable. These characteristics drive one of the most important metrics in hydrogen economics: utilization. Utilization is the silent determinant of returns. An electrolyzer that runs intermittently produces very expensive hydrogen, regardless of how advanced the technology is. An electrolyzer that runs most hours of the year spreads its capital cost over far more kilograms. Ports naturally favor high utilization because the industrial processes they serve operate 24 hours a day. This is why green hydrogen at ports can approach infrastructure-like operating profiles instead of pilot project behavior. Transport is another reason the infrastructure framing holds. Hydrogen is uniquely sensitive to distance. Compressing it consumes energy. Liquefying it consumes more. Trucking it adds cost and risk. Pipelines require capital and permitting. In most locations, these transport layers destroy hydrogen economics before it reaches the user. Ports remove much of this burden by default. Hydrogen moves short distances, inside industrial fences, through pipelines and systems already designed for hazardous gases. When transport costs collapse, the entire system cost structure changes. This is not a marginal improvement. It is often the difference between a project that can be financed and one that cannot. Carbon exposure adds another layer of infrastructure logic. Ports concentrate some of the most carbon-intensive and export-exposed industries in the global economy. Refineries, chemicals, and fertilizers face increasing pressure from carbon pricing, border adjustments, and buyer requirements. Green hydrogen allows these industries to remove carbon at the point of production rather than compensating for it later. For investors, this shifts hydrogen from a sustainability narrative to a defensive one. Defensive investments protect cash flows, contracts, and market access. Boards approve defensive infrastructure far more readily than speculative climate bets. This is one reason port hydrogen projects advance faster than similar projects elsewhere. Permitting and safety alignment reinforce the pattern. Ports already operate under strict hazardous materials frameworks. Emergency response systems, zoning, and liability structures already exist. Hydrogen does not introduce a new category of risk. It adds to a category the system already manages. This shortens timelines and reduces friction relative to greenfield or urban sites. When you stack these factors together, power congestion relief, existing demand, high utilization, minimal transport, carbon defense, and permitting alignment, green hydrogen at ports begins to look less like an experiment and more like an incremental infrastructure upgrade. That does not mean every port hydrogen project works. Many fail. But they fail for execution reasons, not because the idea itself is speculative. They fail when systems are overbuilt, demand is misaligned, or utilization assumptions are unrealistic. Understanding those failure modes is where real investor edge begins. The key insight for investors is this: green hydrogen does not create value by being cleaner. It creates value by relieving pressure inside stressed systems. Ports are among the most stressed energy systems in the industrial economy. That is why green hydrogen shows up there first, and why capital follows. If you are evaluating green hydrogen purely as a technology curve, you will miss the opportunity. If you evaluate it as location-specific infrastructure that stabilizes existing systems, the opportunity becomes much clearer and much narrower. That distinction is where most public discussion stops. And it is exactly where serious analysis needs to begin. If you want to go deeper into how investors and advisors actually evaluate green hydrogen projects, beyond headlines and announcements, that is the type of system-level thinking we focus on at H2 Hub by Renee Energy. It exists for people who need these projects to work, not just sound promising.